Have you ever looked at a candlestick chart and wondered what all those colorful shapes actually mean? It might seem like a jumble of lines and blocks, but each candlestick tells a crucial story about market movement. Let's break it down. Imagine you're watching a race. Each candlestick is like a lap completed by a runner, showing how they started, how they finished, and what happened in between. A candlestick has four key parts: the open, the close, the high, and the low. The open is where the price started at the beginning of a time period, let's say 1 hour. The close is where it ended. The high and low represent the highest and lowest prices reached during that same hour. If the closing price is higher than the opening price, it forms a green or white candlestick. Think of it as a signal that the market is gaining momentum, like a runner picking up speed. If the closing price is lower, it's a red or black candlestick, indicating a slowdown or decline, like a runner losing steam. And here's the surprising part. The length of the candlestick's body, which is the thick part, shows how much price movement occurred. A long body means a lot of movement, while a short body indicates little change. The thin lines, or wicks, show the price range, highlighting the extremes the price reached during that period. In essence, candlestick charts provide a visual representation of market sentiment and price action, helping traders and investors gauge the mood of the market at a glance. So next time you see one, remember it's not just a collection of shapes, it's a powerful story of market dynamics unfolding right before your eyes. What exactly does each candlestick tell us? At first glance, it might just look like a colorful rectangle, but each one is a wealth of information packed into a compact form. Think of a candlestick as a snapshot of price action over a specific time frame, whether it's 1 minute, 1 hour, or 1 day. Here's how it breaks down. Each candlestick displays four key pieces of information. First, there's the open price, which is where the price started at the beginning of this time frame. Picture it like the starting line in a race. It's the point from which everything begins. Next is the close price, where the price finished at the end of the time frame. This is like the finish line, marking the end of that particular race. The distance between the open and close tells you whether the asset gained or lost value during that time. If the close is above the open, we see a bullish candlestick, often colored green or white. Conversely, if the close is below the open, it's a bearish candlestick, usually red or black. Now, let's not forget the high and low prices. The high is the peak price reached during that time frame, while the low is the lowest point. Think of this as the range of a basketball game. The highest and lowest scores reflect the excitement of the match. The vertical line connecting the high and low prices is called the wick or shadow, showing us the volatility within that period. So when you look at a candlestick, you're not just seeing a price, you're witnessing a whole story of market sentiment in a compact format. Understanding this anatomy helps demystify price movements and provides a clearer picture of the market's behavior. So, the next time you glance at a candlestick chart, remember, each one is a little story, revealing the highs, lows, openings, and closings of the market. With this knowledge, you deepen your insight into market dynamics. What exactly do the body and wicks of a candlestick tell us about price movement? Imagine you're at a race. The starting line represents the opening price, and the finish line represents the closing price. The body of the candlestick shows you who crossed the finish line first and by how much, while the wicks reveal the highs and lows achieved during the race. Let's break it down. The body of the candlestick is formed between the opening price and the closing price. If the closing price is higher than the opening price, the body is typically colored green or white, indicating that buyers took control. Conversely, if the closing price is lower, the body turns red or black, highlighting the seller's dominance. Now, here's the surprising part. The length of the body itself is significant. A long body indicates strong price movement in one direction, suggesting that either buyers or sellers are highly confident. But a short body means indecision, showing that buyers and sellers are struggling to take control. Then we have the wicks, or shadows, which extend above and below the body. These wicks reveal the highest and lowest prices reached during the time period represented by the candlestick. Picture them as the peaks and valleys of the race, where the price tried to push higher or lower, but ultimately settled back down to the finish line. A long wick on top indicates that at one point, buyers pushed the price high, but sellers quickly stepped in. A long wick below signals the opposite. Sellers tried to push the price down, but buyers fought back. So together, the body and wicks create a complete picture of the price dynamics over that time frame. Understanding this interplay helps traders gauge market sentiment and potential future movements. Now that you know what the body and wicks represent, you're one step closer to interpreting candlestick patterns. Stay tuned for more insights. Have you ever wondered what the colors of a candlestick actually mean? It's not just about aesthetics. They tell you a powerful story about market sentiment. A green or white candlestick indicates a bullish movement. This means that the price has closed higher than it opened. Think of it like a plant growing towards the sun. When the market opens, it's like the start of a new day for that plant. If it grows and reaches a higher point by the end of the day, that's a sign of strength and optimism. On the flip side, a red or black candlestick signals a bearish movement, meaning the price closed lower than it opened. Imagine a balloon that starts off inflated and then slowly deflates. That initial excitement turns into disappointment as it loses air. This color contrast is not just a stylistic choice, it's a visual representation of market psychology. When traders see a green candle, they often feel more confident, leading to more buying. Conversely, a red candle can create fear or caution, prompting traders to sell or hold back. Here's the surprising part. While individual candlesticks communicate immediate sentiment, watching them in clusters or patterns can reveal even deeper insights. A series of green candles might suggest a strong uptrend, while consecutive red ones could indicate a potential downtrend. Color isn't just a decorative element. It's a clear signal of how traders perceive price movements and can guide their decisions. Understanding the significance of candlestick colors helps you read the market more intuitively. As you dive deeper into candlestick charts, keep an eye on these colors. They reveal the heartbeat of market sentiment. Curious about the next layer of candlestick charts? Stick around as we uncover patterns that traders watch for. What can a simple pattern of candlesticks reveal about market sentiment? Well, it turns out quite a lot. Picture a group of people at a concert. When the music peaks, everyone jumps and cheers, creating a vibrant atmosphere. But when the song slows down, their energy shifts. Candlestick patterns work in a similar way. They capture the emotions and reactions of traders at various moments in time. Take the doji, for instance. This pattern forms when the opening and closing prices are nearly the same, resulting in a small body. Imagine a tightrope walker, balancing precariously. This signals indecision in the market. Buyers and sellers are at a stalemate. A doji often appears at the top of a trend, hinting that a reversal might be on the horizon. Traders see this and start to question, is the momentum fading? Now consider the hammer. This candlestick has a small body at the top and a long lower shadow. Think of it like a rubber band that's been stretched but doesn't snap. It implies that despite the price dropping significantly during the session, buyers stepped in and pushed it back up. This can signal a potential reversal at the bottom of a downtrend, as it shows that buyers are starting to regain control. And here's the surprising part. These patterns don't just stand alone. They often work in conjunction with other candlesticks to form more complex patterns, like the morning star or evening star. These help traders gauge whether the market is likely to reverse or continue its current direction. Understanding these patterns can provide valuable insights into market psychology, aiding traders in making more informed decisions. So when you look at a candlestick chart, remember that each pattern tells a story about what traders are feeling and thinking. It's not just data, it's a reflection of market sentiment that can guide your understanding of potential future movements. If you're curious about more market mechanics, don't forget to subscribe. What does a candlestick chart actually tell you about the market? Think of these charts as a visual storybook of price movements. Each candlestick revealing the emotions and decisions of traders. Each candle represents a specific time period, a minute, an hour, or a day, showing you the open, high, low, and close prices. When you look at a series of candlesticks, you're not just observing numbers, you're witnessing the market's pulse. For instance, if you see a succession of green candles, that's like reading pages filled with optimistic narratives. Buyers are in control, pushing prices higher. But when red candles appear, it's a shift in the story. Sellers are stepping in, driving prices down. Now, here's the surprising part. The real magic happens when you start to identify patterns within these candles. A hammer can signal a reversal after a downtrend, hinting that buyers might be ready to take charge again. Conversely, a shooting star might suggest that the sellers are regaining momentum after a rally. Understanding these movements isn't just about predicting price direction, it's about deciphering market psychology. Traders use this information to gauge sentiment. Are they feeling bullish or bearish? This insight helps them make informed decisions because it reflects the collective mindset of market participants. So, the next time you see a candlestick chart, you'll know it's more than just lines on a screen. It's a dynamic insight into market behavior, revealing the ongoing drama of buying and selling. If you now see candlesticks in a new light,